Okay, so the next standard is IFRS 9 financial instruments. This standard, most likely, it's going to be publicly available since so many of the students have difficulty in understanding the standards. Okay.
Mm-hmm.
So IFRS 9 financial instruments. So financial instruments are actually contract. That means unlike other assets, uh, which we can see, we can do transactions with, financial instruments are basically contracts. Okay.
Mm-hmm. Mm-hmm.
So when there is a financial instrument, the contract would generate two parts. One part would be the financial asset, and the other part would be a financial liability. So the
Okay.
basic logic is that if I am entering a contract with financial asset, if it is financial asset for me as an A, the B person would get it as a financial liability. Understood?
Mm-hmm.
Okay. Now
Understood.
coming on to financial assets. So financial assets are contracted right. Okay,
Mm-hmm.
contracted right. So contracted right means you have the right to receive cash, okay, or you have the right to receive any other sort of financial instruments, but under favorable terms. That means it is going to benefit you somehow. Clear?
Okay.
The
Okay.
examples are trade receivables, purchase of loan notes, okay,
Mm-hmm.
and shares of other companies, okay.
Okay.
And when it is a contracted obligation, it specifically means that you owe money or in kind to other person. Understood? So you're obligated to pay cash, okay,
Mm-hmm.
and this would lead you to transfer financial instruments under unfavorable terms. Clear?
Mm-hmm. Clear.
Okay, example is the loan notes, the trade payables, etc. Okay, so definition,
Mm-hmm.
contract where one party gets financial asset and the other party gets a financial liability.
Liability.
Okay, so
Okay.
financial liability is where you borrow funds from the investors. Okay, so you got the money because someone decided to invest that money somewhere else, right?
Mm-hmm.
Okay, so here there is an obligation to pay back what we receive. Okay, no?
Yes.
So, if the company is having a contractual obligation, then the company would give them, deliver the cash back, whatever they are receiving. Clear, no?
Yes. Clear.
Now, how do you record a financial liability? So, for that, you just need to make sure under what type you are buying that financial instrument. Okay, that is the liability.
Mm-hmm.
So the liability can be divided into two: trading instruments and derivatives, and non-trading instruments and debt instruments. So derivative is nothing. You are going to study in detail about derivatives in your FM, okay, and
Okay.
AFM. Here in FR, you don't really need this. I'm not going to go in detail and ruin your FR, okay?
Okay.
Derivatives, I hate derivatives in AFM, okay?
Okay.
Okay, so the trading instrument, from the name itself, it is evident that it can be any time traded to someone else. That means you're going to pass the obligation to somebody, someone else that you intend to give it. Clear?
Mm-hmm.
So if the liabilities are held for trading, it is a trading instrument. Example is options, futures, etc. So options and futures are derivatives. Derivatives are something that is sort of an hedging instruments. So hedging is done so as to minimize the risk of uncertainties that may happen with your assets in the future. Clear?
Mm-hmm.
For the
Clear.
knowledge, it is enough.
Okay.
Okay. So if it is trading, then that means you're not holding the asset for a very long time. You may sell it soon, right?
Mm-hmm.
So the criteria of measurement is as follows. There is an initial measurement and a year-end measurement. Clear? So
Mm-hmm.
initially you're going to measure it at fair value, okay? And the transaction cost is going to be expensed in SOPL. Clear now?
Clear.
And in the year end, you're going to use fair value through P&L. That means you're again going to revalue the financial liability, and the gain or loss could be taken into profit and loss account. Clear? That means in the statement of
Mm-hmm.
profit and loss. Clear?
Yes. Clear.
And then you're going to remeasure the value into fair value. Clear? That means the liabilities latest measurement would be the fair value that you have calculated at the latest. Clear?
Clear.
Understood? Now,
Mm-hmm.
the gain or loss is going to be taken into SOPL. So, the major difference is that the fair value is actually taken separately and the transaction cost is transferred to the SOPL. Clear, no?
Mm-hmm. Clear.
Now, next category is non-trading instruments and debt instruments. So, non-trading means you're not intending to sell it to someone else, right? And the
Mm-hmm.
company is going to issue that, for example, loan notes. If the company is owning the loan notes and they are issuing to the public, then that becomes a non-trading element. Clear?
Clear.
And there are two measurements, initial measurement and the year-end measurement. Clear?
Mm-hmm.
And initially, you're going to value it at fair value, and which is going to be equal to the nominal value of the liability. So, if you are purchasing a loan note of, let's say, $70,000 of 100 each, then that initial value is your nominal value. Clear?
Clear.
Now, the transaction cost is to be deducted from the fair value. So, from the 7,000, you're going to deduct the transaction cost. Now, this happens because it is a non-trading instrument. Understood?
Mm-hmm.
Okay, and in the year end, you're going to use a method called amortized cost method, which is kind of a table that we would study in later on. Clear?
Okay, clear.
Now, next one is convertible loan notes. So, convertible loan notes, as in these loan notes that you issue, could be converted into equity in the future on the hands of the person who is buying it. Clear?
Mm-hmm.
Understood?
Somewhat.
So there are two measurements in the initial measurement, that is in the opening balance, and the year-end measurement. Clear?
Mm-hmm. Yes.
Initially, what we would do is we're going to split it between debt and equity because
Okay.
it's in the hands of the investor that whether or not they decide to make it an equity. That means the person who is buying your loan notes would have the right to exercise the equity option. Understood?
Mm-hmm.
Okay, so the debt can be converted into equity. That is ownership. Okay.
Okay.
So the
Okay,
debt
clear.
opening balance is going to be the present value of future cash flows given by the company on this loan. So you would be given a data where the present value of the cash flows would be calculated. That means you would be given a discounting factor and the amount of money that would be equivalent to the installments that you are going to pay. Clear?
Mm-hmm.
So you're going to take that, okay? And then you're going to take the nominal value. Nominal value as in the initial value. And the difference could be the equity option. Understood?
Understood.
This is the balancing figure. Okay?
Okay.
These two would be given to you, and you just need to find this one. Clear? Now,
Okay.
now in the year end, what you do is you're going to again use the amortized cost method, that is a table method, in order to find the debt. Okay? And
Mm-hmm.
equity is same as you have found here. Clear, no?
Clear.
Equity doesn't change. Now,
Okay.
the next category is financial asset. So, liability is something that we owe, right? So,
Mm-hmm.
financial asset is the opposite of it. That means it's like an asset, a debtors, it could be anything. Clear?
Mm-hmm.
So this is where we are on the receiving end. Understood?
Yes, makes sense.
Okay. So there are
Mm-hmm.
two types of financial asset that we could own. One is purchasing another company's shares, equity. All right. Or
Mm-hmm.
the other is to purchase another company's loan notes. Then again, they are entitled to give us cash. Clear?
Mm-hmm.
And as far as this goes, the loan notes, as far as the loan notes go, the treatment is same as here. Clear?
Okay,
Understood?
clear.
Same as the
Yes.
financial liability, but instead of giving, you are getting. That's all.
Okay.
Okay. Now,
Mm-hmm.
in the purchase company share, we are going to divide it into two categories, that is trading and non-trading. Okay. So, if in the
Mm-hmm.
question you have not been given an option, by default, it is a trading instrument. Clear?
Okay, clear.
And if there is a choice, that is, if you can elect, it is non-trading. Clear?
What does it mean by choice election?
That means by choice, if you want to consider, you can take it as a non-trading. But by default, every equity instruments that you get is a trading instrument. Clear?
Okay,
In the
okay.
question,
Makes
in the
sense.
question, if it is not specifically mentioned, then that is a trading instruments.
Okay.
Sometimes the question would have a choice. They would specifically mention that it is a non-trading instrument. Clear? If
Clear.
nothing is mentioned, it is a trading instrument. Clear?
Clear.
Okay. So there are two kinds of measure, two categories of measurement. Under that, there is an initial measurement and there is a year-end measurement. This we are talking about trading instruments. So we are looking forward to sell this in the future as soon as it is, as soon as we are ready, right? So
Mm-hmm.
initial measurement would be at fair value. The transaction cost, that is whatever amount that you have occurred in order to get that ownership, that amount is going to be expensed. Clear?
Mm-hmm.
And in the year end, the asset is then revalued again to the fair value. Any gain or loss is taken into SOPL. Clear? And this
Clear.
method is called fair value through P&L method. Understood?
Mm-hmm.
Now, the non-trading means you're keeping it so that you can get money from it, right?
Mm-hmm.
So the initial measurement is same as any other asset. You're going to take the fair value for it. You're going to add the transaction cost. That means capitalize the transaction cost. Understood?
Mm-hmm.
Okay. In the year end, you are again going to convert it into fair value, the latest fair value. The
Mm-hmm.
gain or loss, instead of taking to P&L, you're going to take it into OCI. Clear?
Okay. Clear.
And then after that, you're going to take it into other reserves. Clear? And
Mm-hmm.
this method is called fair value through OCI model. Understood?
Understood.
Okay. Now, the dividend that you receive from such financial assets, it is taken as an income under SOPL. Clear? Under both
Mm-hmm.
methods. Okay, now?
Clear.
Now, purchasing loan notes. So, what happens if there is a purchase of loan notes? For purchase of loan notes, you need to make sure it covers both the tests. Now, what are the tests? First test is called business model test, and the second test is called cash flow test. Clear?
Mm-hmm.
So, what is a business model test? The business model test actually looks why this loan note has been purchased. Okay. So, you can
Mm-hmm.
take the loan notes either for two reasons. One of the reason is you're going to buy it and you're going to keep it until the maturity is done, right?
Mm-hmm.
The other method is you're going to sell it off once you get a better price, right?
Mm-hmm.
So if the company's objective is to hold the loan note until maturity and collect all the cash flows from it, okay, then the
Mm-hmm.
business model test is passed. Clear?
Okay.
Now, what is a cash flow test? So the cash flow test is looking towards the reason for the company purchasing loan notes. That is it in order to get the cash? Clear? That is with
Mm-hmm.
interest, you're getting cash. If your main aim is that, then a cash flow test is passed. Clear?
Clear.
So if both the test is passed, that means you're keeping it until maturity. You're looking forward to receive interest in the form of cash from the loan notes. Then that means both are passed and it is a non-trading purpose. Clear?
Mm-hmm.
If
Okay.
if tests are not passed, it is a trading instrument. Clear?
Okay.
So for non-trading, what is the measurement? You're going to take the fair value. Initially, you're going to add the transaction cost. Okay. And
Mm-hmm.
at the year end, you're going to use amortized cost method. That is a table format. Clear?
Okay.
If it is, if only one test is passed, you're going to take it as a fair value through OCI model. Clear?
Clear.
Okay. So for the trading part, you're going to take the initial measurement as fair value. You're going to expense the transaction cost. In the year end, you're going to take the fair value and the gain or loss is being taken in SOPL. Clear?
Clear.
Understood?
Understood.
Okay. If only one test is passed, you're going to use the same thing. But instead of using fair value through SOPL, you're going to use fair value through OCI model. Understood?
Mm-hmm.
Okay. No amortized
Okay.
cost method.
Okay. Okay.
Clear, no?
Mm-hmm.
Okay. As far as the theory is concerned, it is done. We'll be starting with the problem. Just a
This
minute.
is the worst.
This is a lecture that you might want to repeat again in future. Okay.
Mm-hmm.
So it is 1st January 2001. Okay. AB
Mm-hmm.
company issues a 6% loan note at its nominal value of 200,000. They are issued at a 5% discount. So this is loan note we are talking about. Clear?
Mm-hmm. Clear.
1700 of the issue cost are incurred. So issue cost means transaction cost. Understood?
Mm-hmm. Mm-hmm.
The loan notes will be repayable at a premium of 10% after 4 years. So after 4 years, what happens? You have to pay 10% extra. Now
Okay.
remember, you're getting 5% less, but you have to pay 10% extra in 4 years.
Mm-hmm.
The effective interest is 10%. Prepare the extracts of SOPL and SOFP for the years of 4 years. Okay.
Okay.
What we are going to do is first, it is a loan notes that is being purchased, right?
Mm-hmm.
Okay. So the loan note is purchased. So how do you measure it? It is taken for 4 years. They have already told you. Okay. So the
Okay.
opening balance is going to be 200,000. Okay.
Okay.
No doubt about it.
No.
Now, you're getting discount as a 5%, right? So when you get the money, it is 5% less. So how much do you get? 95%, right?
Mm-hmm.
Clear? The logic is clear.
Yes, clear.
Okay. So
Minus
how?
5%
Yeah.
discount. Mm-hmm.
Yes. Okay.
Mm-hmm.
So how much are you getting? It is 200 into 95%, right?
Mm-hmm.
So you're getting 190,000. Clear?
Clear.
So from 190,000, so from 190,000, you have to deduct the issue cost. Clear?
Mm-hmm.
Okay. They haven't mentioned whether it is non-trading or trading, right? So
No.
as I've told you, by default, if it is not mentioned, what is it? Trading.
Trading.
Understood?
Mm-hmm.
So if it is
Yes.
trading, you're going to take away everything from it. Clear?
Okay.
Understood? Sorry,
Mm-hmm.
sorry. They haven't mentioned if it is not trading or trading, but they have told you that it is going to be for 4 years, right?
Okay.
Note will be repayable after 4 years. Okay. So we're going to assume that until 4 years they're holding it. Clear?
Okay. Clear.
That is holding till maturity.
Okay.
Right? So what do you
Mm-hmm.
do? You're going to take it as a non-trading instrument. Understood?
Okay.
Non-trading.
Makes sense.
Because
Okay.
yeah, because they're going to repay it after 4 years.
Okay.
So the issue cost, you're going to deduct how much from it? 1,700, right? So
Yes.
what's the
Okay.
value? 108, the 1,800, sorry, 188,300 is the value. Clear? That
Clear.
is the opening balance. Understood?
Mm-hmm.
We're going to directly take the opening balance here. Clear?
Mm-hmm.
Understood?
Understood.
Now, so this becomes a non-trading instrument issued by the company. Clear? So here, understood? So this is what we did just now. We are going to do year and measurement now. Clear? Hello? Can you hear me now? Hello?
Hello.
Yeah, can you hear me?
Yes, I can hear you.
Okay. So we have already done this part. Okay. This is
Just a second. I
non-trading
can't
instrument.
see your screen.
Okay. Sorry.
It's okay. Okay, I can't see now.
Can you hear me? Hello? 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 Hello,
I can.
can you hear me?
Okay, I can see your screen moving.
Can you hear me now?
Yes, I can.
Okay. So I've told you it is a non-trading instrument since they have
Mm-hmm.
decided to hold it till 4 years, right? They're
Mm-hmm.
paying the money.
Yes.
Clear?
Mm-hmm.
So the initial measurement we have already done. We have taken the fair
Yeah,
value
we already did
and
that.
value. We have deducted the transaction cost from it. We have also adjusted the discount as well. That is the extra thing that
Mm-hmm.
comes. Clear? And
Okay.
in the year end, what we do is amortized cost method. So what is an amortized cost method? It is nothing but this table. Clear?
Okay.
This table is amortized cost method. Clear? It's not something that
Clear.
is very big to understand. It is just this
Okay.
table. Clear?
Okay.
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 So in this table, in this column, we are taking the number, the years in question. Clear?
Mm-hmm.
So in this
Mm-hmm.
question, it is 4 years. Clear? And in the
Okay.
second
Clear.
column, we are going to take opening balance. So opening balance, the first balance, we are going to find it. And from the second year onwards, the opening balance becomes the last year's closing balance. Understood?
Yes, makes sense.
Okay.
Mm-hmm.
So we have already found the opening balance,
Mm-hmm.
188,300, right? Now,
Yes.
they've already told you the effective interest is 10 percentage, right?
Mm-hmm.
Understood?
Yes.
So that means
Understood.
this is equal to this into 10 percentage. Understood?
Mm-hmm.
Okay. Now,
Okay.
on a yearly basis, how much are you going to pay? On a yearly basis, how much are you going to pay? You're going to pay 6 percentage loan note. See, the interest payment or the cash payment is always over the loan note's name. So what is the loan note's name here? 6 percentage loan notes. Clear?
Mm-hmm. Okay. Clear.
So that is equal to 200,000, okay, into
Mm-hmm.
6 percentage. Clear?
Okay. Clear.
And this is going to be a negative amount. Understood, no?
Understood.
And the closing balance is this plus this, okay,
Mm-hmm.
minus that amount. Understood?
Okay.
Okay. And the
Okay.
last year balance becomes the current year's opening balance.
Mm-hmm.
Understood?
Understood.
Just going to drag and drop again. Okay.
Mm-hmm.
Understood?
Understood. Okay.
Clear?
Clear.
Okay. It is automatically calculated.
Mm-hmm.
But when you're going to get a mark, a question on NCQs, you have to manually calculate everything. Clear?
Okay. Clear.
Okay. So the NCL part goes to here. That is all the closing balances. Okay.
Mm-hmm.
And as for the finance cost, it is going to be always the effective interest. Clear?
Okay.
Oh, sorry, it is the effective interest. The effective interest part.
Okay.
I've taken the opening balance.
Mm-hmm.
Clear?
Clear.
We are done with the first question. Let's see the second question. Hmm. The second question is same as the first question. So this is a homework for you. Clear?
Okay. Okay.
We'll do this question. Okay. A company issues 20 million of 4% loan notes at par on 1st January 2009. Okay. The loan
Okay.
notes are redeemable for cash or convertible into equity shares on basis of 20 shares per 100 of debt at
Mm-hmm.
the option of the loan note holder on 31st December 2011. Similar but non-convertible loan notes carry interest rate of 9%, so that becomes the effective interest. Clear?
Okay.
The present
Clear.
value of $1 receivable at the end of the year based on the discount rates of 4% and 9% can be taken as below. So here I myself striked it down, but in the exam you would be given these two values. Clear? So out of that, you
Okay.
need to select only the value of your effective interest part. That means the 9%. So this is not to be taken.
Okay.
Clear? So this
Okay.
is the
Clear.
discounting factor that you should be concerned with. Clear? So
Mm-hmm.
what is the
Clear.
requirement? Show these loan notes, how these loan notes should be accounted for 31st December 2009. Clear, no?
Mm-hmm. Clear.
Okay. So we have to first identify how much we are going to pay as a cash paid. So that equation is going to be what? The nominal value into the loan note percentage. Clear?
The nominal value into
Is
the
20 million. See?
20 million. Okay. Okay.
It's a
Okay.
4%
Got it.
convertible loan note. So that means
Okay.
what you pay is 800 per year.
Okay.
Understood? Okay.
Understood.
So the loan note was purchased on which date? 1st January.
Mm-hmm.
And the requirement has been telling you to, has told you to get the value on 31st December 2009. So what is the duration that you're going to find? 1 year.
1 year. Mm-hmm.
Clear? So
Clear.
you need to find the opening balance first of the debt. Okay. So
Okay.
what you're going to do, you're going to drag these up. Clear?
Mm-hmm.
The discounting factors. And
Okay.
then you're going to take the cash flows each year that you have to pay if you're purchasing the loan note. So how much is
Okay.
the cash that you're going to pay? You're going to pay 800 each year. That is good to
Mm-hmm.
go. That is every year you're going to pay 800. But in the
Okay.
last year, you need to pay 800 plus the amount of 20,000. That means 20 million. Clear?
Okay.
Okay. And how do you
Mm-hmm.
get the present value? Present value is equal to the discounting factor into the cash flows. Clear?
Clear.
Okay. So that is this much. Understood, no?
I understood, but why are we paying the original one plus the 800 and the third year again?
Because in the third year, they have already told you after 3 years, is it? Wait. Mm, see, after end of the 3 years, you're going to pay the amount that is whatever amount that you took plus the last year interest, right?
Okay.
Suppose we keep it at this, keep these at a side. Okay, you have taken a loan from the bank.
Okay.
Let's say the bank loan is for 10,000
Okay.
at a 10 percentage interest, which is
Mm-hmm.
repayable after 3 years, let's say.
Okay.
So in the first year, you are going to pay interest, 1,000. The second year,
Uh-huh.
you're going to pay interest, 1,000 again, right? Third
Mm-hmm.
year, you have to pay the interest plus you have to pay the loan back, right?
Okay, makes sense.
So same
Mm-hmm.
logic. So in the third
Okay,
year, you're
makes
paying
sense.
interest as well as the initial nominal value back. Understood?
Mm-hmm. Understood.
So, but you have to find the PV. That is the condition.
Mm-hmm.
Clear?
Okay.
For
Clear.
convertible loan notes, you have to find the cash flows in the
PV.
future. Clear?
Okay,
So
yes.
how much is it in total? In total, this is going to be this much amount. Clear?
Mm-hmm.
But you know, the debt has a nominal value of how much? 20,000. Clear?
Mm-hmm.
So what would be the equity option? Option would be the difference between these two things. Clear?
Clear.
Okay. Now, the equity option does not change in the year and it remains same. Clear?
Clear.
But what changes? The debt instrument would be taken in ACM method, right? So the opening balance you have already found, that is 17,424. Effective interest is going to be 9%, right?
Mm-hmm.
Okay. And the cash paid is going to be minus 800 that we have already calculated. What is the closing balance? This one. Understood?
Understood.
Okay. And here you have taken the finance cost here 1568 and the equity option would be taken under equity. Clear? 2576 and the convertible loan note closing balance would be taken here. Understood, no?
Okay. Understood.
Okay, next question. This one, you would be thorough only after doing this yourself. Okay?
Mm-hmm. Yeah.
When I do, you only get the idea, but you have to do yourself in order to, learn that.
Yeah. Mm-hmm.
Next question. In February 2008, a company purchased 20,000 $1 listed equity shares. So this is financial asset that we are talking about at a
Okay.
price of 4 per share. How did I understand it is a financial asset? Because we purchased an equity. We purchased equity. When we purchase an equity, when we purchase a loan note, it becomes an asset. Okay. When
Mm-hmm.
we issue a loan note, it becomes a liability. Understood?
Okay.
Clear? So here we
Clear.
have purchased 20,000 equity shares of one each with a market price of 4 per share and it had a transaction cost of 2,000. At the year end, December 2008, these shares were trading at 5.5, that is the fair value. A dividend of 20 cents per share was received on 30th September 2008. Show the SOFP extracts for 31st December 2008 relating to this investment on the basis that first scenario is it is for trading. The second scenario is it is not for trading. Clear?
Mm-hmm. Makes sense.
Okay. So the shares were bought as a source of dividend income. That means it is a cash flow based thing. And also they have decided that the recognition would be through fair value through OCI. Understood?
Okay, wait. Are they saying we solve if it was bought for trading, and then the second one if it was bought to be a source
Not
of
trading. That
dividend?
means we are not selling.
Okay.
Basically, it's
Okay,
that.
so we're preparing two scenarios.
Yeah, we're preparing two scenarios.
Okay.
So first
Okay.
scenario is trading, right?
Yeah.
Okay. Okay. So for trading, It is a 20, we have to convert it into opening balance into its fair value, right? So at
Mm-hmm.
that point in time, that is on 1st February, there is no depreciation, so you don't care at which date you have bought it, as far as it happens in the current accounting period. Clear?
Clear.
Okay, so it was on February 2008 that you bought the asset, and at that time it had a price of 4 per share. So you're not going to take the 20,000 into 1, you're going to take 20,000 into 4. Clear?
Clear.
So 80,000. Clear?
Mm-hmm.
Now, the closing balance, the transaction cost is 2,000, which is to be taken under where? Under SOPL as an expense because it's a trading, right?
Okay.
Now you
Mm-hmm.
have to find the closing balance. So you know at the end of the year, how much has it become? 5.5,
Mm-hmm.
right? So this is equal
Yeah.
to 20,000 into 5.5. And the difference is going to be the fair value gain or loss. Clear? So this is a
Clear.
fair value gain. Understood?
Understood.
Could be loss as well, but here it is gain. Understood? No? And since it is a trading instrument, it is going to be taken under SOPL. Clear?
Mm-hmm.
So under SOPL, you're going to take the transaction cost, right, as a negative figure because it is an expense. You're going to take the fair value gain, and also you're supposed to take the dividend income, right? So dividend income,
Okay.
regardless whether it is received from trading or non-trading, you're going to take it into SOPL as an income. Clear?
Mm-hmm. Okay.
The dividend income is equal to how many cents per share? Let's see. Where is it? 20 cents per share. 20 cents as in 0.2 pounds, right? 0.2.
Uh-huh. Okay.
So
Okay.
20,000 into zero point 0.2. Clear?
Okay. Clear.
Understood, no? So under
Understood.
equity
Clear.
instrument, you're going to take the last value that you have calculated, the closing balance. Okay?
Okay.
So this is to it. Now the second method is non-trading instruments. Okay? So the
Mm-hmm.
same thing applies. You're going to take the fair value of the item. Okay? And instead of expensing the transaction cost, you're going to capitalize it. So the balance becomes 2,000 plus 80,000. Clear?
Clear.
Understood, no? Now in the year end, you have actually revalued the investment again under fair value, and this is how much it is. And the difference of this particular amount would be taken into OCI because you're using fair value through OCI under non-trading instruments. Understood?
Mm-hmm.
Okay. So
Okay.
in the SOPL, you would have the dividend income as well as under OCI, you're going to get the fair value gain or loss of equity instruments. Now, in the equity instruments, the value is going to be how much? Under non-current assets, it is going to be the closing balance. It is asset, it's not liability. Clear?
Clear.
And under other reserves, you're going to take the amount that you got as a difference. That is this one. Clear, no?
Mm-hmm.
Okay,
Okay.
that's it. Now, the next question is going to be your homework.
Okay.
Same thing. Okay. Now, we're going to deal with the last part of the question. Okay.
Yeah.
Let's see. A company invests $5,000 in 10 percentage debentures. Okay. Debentures is same as a loan note. Clear, no?
Okay.
The debentures will be repaid of a premium at the end of their term, and A intends to hold these debentures until this time. Okay.
Mm-hmm.
Now, the effective rate of interest is 12 percentage. Prepare its tracks of SOPL and SOFP for the year ended 1 and 2. Clear? Okay.
Okay. Clear.
Now,
Mm-hmm.
this is debentures, right?
Mm-hmm.
And we have invested, so that means it's an asset. It's something that we have to receive. Clear?
Mm-hmm. Clear.
So the opening balance is 5,000. One model is passed, right?
Mm-hmm.
Okay. And
This
this
is
is just,
for year one.
yeah, and this is just a matter of cash flows, right?
Okay.
And they have already told you A is intending to hold the debentures until this time, right? Okay, so holding
Okay.
test is passed. You are collecting cash flows from it. So tell me if it is a trading or non-trading.
It's non-trading.
Yes. And it is a debenture. So ACM, okay, you have to
Mm-hmm.
keep in mind ACM is in question. ACM means the stable. Clear, no?
Okay.
Hence, we have taken the table. Since there is no transaction cost and stuff, we are going to take 5,000 as it is as the opening balance. Clear?
Okay. Clear.
If there is a transaction cost, you have to take it together. Understood?
Understood.
Since there is no transaction cost, you're going to take the 5,000 as the per value. Clear? You're
Clear.
going to have to take the effective interest, which is given to you as 12 percentage, right?
Okay.
Understood? And the
Mm-hmm.
cash paid would be 5,000 into 10 percentage. So
Makes
cash,
sense.
they pay cash means what do we get? The cash.
Okay.
So cash paid by them becomes the cash received by us. Clear?
Mm-hmm. Clear.
Okay. So the closing balance is 5,000 plus this one minus they have already paid off the 500. Understood?
Understood, but why? Because okay, it makes sense. So it's the same scenario as the interest, where they
Yes,
pay interest. Okay,
yes,
makes
yes.
sense.
Same thing. But instead of
Okay.
we are on the receiving end, that's all.
Yeah, we are. Yeah,
For
that's
them,
why
it
we're
is a
separate.
liability. For us, it is an asset. That's all.
Makes sense. Makes sense.
So listen to me carefully. This particular part would go to SOPL as income. Clear? Instead of
Okay.
finance cost, it is what? It is income.
Income. Okay.
Clear?
Why
And this
isn't cash
particular,
paid the income?
yeah. Instead, usually what do we do is we take it as a financial cost if we are purchasing a loan note, right?
Okay.
So here the company has invested in debentures. So that means we
Mm-hmm.
have taken a debentures. So whomever we have taken the debentures, they are liable to us. That means they have the obligation to pay us interest. Clear?
Mm-hmm.
So
Clear.
this interest becomes our income in SOPL
Okay, makes sense.
because we are on the receiving end. Cash
Yes.
paid means we are not taking actually the cash paid, we are taking the effective interest because there is a question of time value of money. Clear?
Okay.
So always
Some
effective
points.
interest is taken as the cash that we receive. Clear, no?
Okay.
Okay, so if we have received this, so this becomes an income in SOPL, and this becomes the closing balance in SOFP under non-current assets. Clear?
Okay. Clear.
So that's it. Okay?
Okay. When we say cash paid, it's being paid by the other party, right?
Yes, yes. Cash paid is
And
basically
okay.
not the thing that we can take. This is effective interest is something that we take in financial reporting. That's all. It's the
Okay.
standard. It's the rule.
Okay, I understand, but what's the difference between cash paid and the earning interest?
Mm, let's say you have taken a 10,000, let's say, yeah, a 10,000 loan from the bank. Okay.
Okay.
So this is repayable after 3 years.
Okay.
So what you do is every year you're going to pay a portion of the principal amount to the bank. So
Mm-hmm.
that principal amount is this one. So as and when you pay, your interest becomes much less. Understood?
Okay.
That is this part. Clear?
Uh-huh.
But we
Mm-hmm.
can't record this because we have already included this in the opening balance.
Okay,
So
makes sense.
extra amount that we get is only the effective interest.
Mm-hmm.
Understood?
Mm-hmm. Okay, makes sense. Yes, understood.
Okay.
Okay.
Now I'm going to give you problems from the other text as well.
Okay.